All right, it's 11, so we will get started here. Thank you everyone for being here. My name is Juan Montes. I'm an enrolled agent. Enrolled agents are, everyone knows what a CPA is, which is someone licensed by the state of California. Enrolled agents are licensed by the federal government. There are a few minor differences in what the licensures allow or don't allow, but in general, both are tax professionals, and the most important thing, especially in the area of real estate taxation, is working with people who are familiar with this area, experience with this area, and have clients in this area to make sure that you're getting the most benefit for any activity you're engaging in. A little bit about me. I'm a 16-year tax pro. My bachelor's degree is in accounting. I'm a licensed enrolled agent, and I also have a law degree. So part of my practice is I defend a lot of audits. I defend a lot of individuals who have tax debt and need to negotiate it away with the IRS. For example, about 3 years ago, I had a real estate agent who owed the IRS over $350,000 for some old tax debt. And we were able to get her a settlement where she paid $4,200 and the debt went away. So I do that, defend a lot of tax cases and audits, as well as I help individuals plan out their tax circumstances to lower and minimize their tax bill as much as legally possible. And that entails, preparing some tax returns and working with various different types of entities. So we'll jump into the presentation here. Depending on the size of the group and the number of questions, people could just jump in and ask questions. If the questions tend to be too many where we won't get through the material, I'll ask that we hold questions toward the end. But if we're able to just continue to move through this, then just jump in and ask your questions. And if we need to change that, we'll do that. So we'll start with SCorp, just because it's such a popular thing. There's a lot of information about it on the internet, both YouTube videos and articles, and then people just talk and tell each other things, which is great. That's how we all come into new information. Unfortunately, a lot of the information that's out there is not very good. So today I'm going to give you some high-level overview talking points on SCorps that will help you understand a little bit what this actually means. So SCorp taxation is it's called a tax election, meaning you would form a corporation, and when a corporation is formed, you would be taxed as a regular C corporation. But in order for the S corporation rules to apply to you, you would have to make that election with the IRS, which when you do it with the IRS, it automatically applies to the state of California as well when it's approved. And there are many differences between SCorp and SCorp, but the biggest difference between the two is that with a corporation, a regular C corp, the corporation would pay taxes on the profit, and then the shareholder would pay taxes on their dividends and or salary. So there's a double taxation there. With S corporation, the corporation itself is not paying the income tax, and all of the income is going to flow to the shareholder, and the income is going to arrive in the form of, I call them buckets. There's going to be, total profit, whatever that is. And then between the two tax returns, you're going to have a breakout where some of that income is going to show up on a W-2 for you as a realtor. And then some of it's going to show up on a form called a K-1 as the owner of the corporation. So the W-2 represents what's called reasonable compensation, meaning what would somebody doing this kind of work earn? And that's what that reasonable compensation number should be. And then whatever profits above and beyond that exist will flow to you as the shareholder owner of the corporation, because those are your profits, what you're entitled to. So the biggest point to understand from an SCorp taxation, when you hear that it saves people money, is the biggest place where you see savings is in that the bucket that flows to you as an owner, as a shareholder, the amount that shows up on the K1 is not subject to Social Security and Medicare tax, which adds up to roughly 15% in savings. And really, that's where the majority of the savings come from. So here's a quick example. Let's say somebody earned a total of $142,800. The reason I chose this number is because for 2021, it's the threshold on which people have to pay into the Social Security system. And as I mentioned before, the biggest place where people save money when it comes to an SCorp is from not paying that 15.3% on an entire $143,000. So here, the quick example is that, let's say somebody does have an SCorp set up. They're on payroll to the tune of $60,000 a year, but they really made a total profit of $142,800. So what that means is if they were a sole proprietor, they would be paying tax on $142,800 to Social Security and Medicare. And as an SCorp, the way it's broken out in those two buckets, as I described, is $60,000 as wages on a W-2. And then the rest of that profit would show up on a K-1 of $82,800. So as you can see, both the total taxable amount is the same. However, the amount that is subject to Social Security and Medicare tax is very different. One is the entire amount for sole proprietors, and for someone with this kind of SCorp setup, only $60,000 of the total profits would be subject to Social Security and Medicare. And then at the bottom there, I have what that calculation would break out to be roughly. So for the sole proprietor person, and we're talking separate from federal income tax and California income tax, because those numbers will vary a bit, but the majority of the difference is going to be in the Social Security and Medicare area. And as you can see, a sole proprietor would pay $20,000 on that 142, whereas someone who's operating in a manner as an SCorp would be 11,700. So you have roughly there just over $8,000 difference in tax savings. So here's some of the pros of being an SCorp. There's lower audit risk, although this may be changing. One of the IRS's stated objectives is that they want to audit more of these SCorps because there are a lot of people who have SCorps but are not paying themselves the wages, W-2s, as they're supposed to, or people who are paying themselves on W-2 as they're supposed to. Maybe they're not paying that right amount. So the IRS is looking to open more audits in this area. So, the fact that it's lower audit risk might not be the case for too much longer. We don't really know. It depends on IRS resources. Overall, audits are down year over year for about the last 8 years. So again, as of today, it's a lower audit risk, but that may be changing. When someone's incorporated, and I really won't get into this area, this is where people need to speak to their attorneys, is in general, corporations have some liability protection. Insurance can work pretty well too. Another pro is your accountant will handle most of the work and the tracking. Obviously, you're going to pay them for it, but at least in my office, I don't have any SCorp clients where I'm not also handling the books, just because as of January 1st of 2018, the rules changed on the way the SCorp tax returns need to be prepared and what needs to be on them. And there is no one who is not an accountant or familiar with double entry accounting who can do that right. So I've never seen a client do that right. So we don't prepare tax returns, SCorp returns, unless we also do the accounting. And then another pro here is you're going to be saving, in the example I showed, about $8,000 in Social Security savings. But the benefit here is then you get to take that money and invest it as you see fit, whether that be in real estate, as a lot of realtors do, or whether that be in handling your own investments, having your own Charles Schwab, Robinhood, whatever type of account you like, because you're probably going to do a lot better job investing this than Uncle Sam is. And over time, your $8,000 are going to grow probably a lot more than whatever Uncle Sam would make that amount grow to be based on your future Social Security benefit payout. Some cons: there will be compliance costs. You're going to have accounting, you're going to have to be on payroll, there's going to be a separate SCorp tax return, and then California charges a franchise fee, which is a minimum of $800. And depending on how large the profit is, that number can increase, but it's at a minimum of $800. I didn't include in the pros, actually. Here is another con: is the lower SEP IRA contributions. However, you are able to create 401ks and things like that. So there are kind of ways around that. But in general, the basic SEP IRA account that is easy, where you just talk to your local bank and say, hey, I want to set up a SEP IRA, and there aren't additional fees or anything like that. The contributions will be lower just because profit, about 20% of profit is what can be put into a SEP IRA. However, when you're looking at what that profit is, only the amount on the K1 is what counts, not the W2 portion of it. So there would be some differences there. And then lower qualified business income deduction. The reason for that is because of the profits. Same thing, because of the way the buckets are split out. So there are differences there in that calculation. And then the other con for those individuals who save the money but then do not end up investing it for the future, if they they were to spend it, not invest it, then down the road when they do retire, they'll have a lower Social Security payment, and they might have been better off just paying the full tax bill for the next 20-30 years to have a larger Social Security payout rather than spending it. So this can be a con if people don't actually take those savings and then invest them for themselves for the future. On SCorp, I'm not going to say too much more than that. These are really kind of high-level overview and the biggest reasons why SCorps are popular and how they save people money. But I think one of the things that people forget to mention whether it be an article online or videos or whatever it is that there are costs to this, and the cost of compliance can be significant. So always, when you're discussing this with someone, make sure that the question of, okay, I'm going roughly, what will I save and what is it going to cost me? Because in reality, your savings are what you save after what you have to spend. So it'll be there'll be a difference there. And then second topic we're going to discuss is real estate professional status. So real estate professional status is one of those areas that can be huge. You don't have to be a realtor or a broker to have real estate professional status. We'll discuss what the rules are, but first I'll tell you what this is exactly. So when someone owns real estate investment properties, as you guys know, especially on more expensive properties, and when you do a cost segregation study, it's possible to accelerate depreciation and then offset it against other income and significantly lower your tax bill. Now, the pro to that is you don't pay taxes now. The con to that is down the road, you're going to use up that depreciation quicker than you would have if you just took the regular 27.5-year depreciation or the 39-year depreciation if it's commercial. But real estate professional status can be huge. I have a client who purchased a $3 million property. He is a real estate professional because he owns a ton of properties, and he qualifies more than anything, and I'll explain what those rules are. And what's going to happen is we're projecting out that for the next 10 years, roughly 10 years, 8 to 10 years, he's not going to pay a single penny in income tax on revenue of probably a little over $200,000 in profit. And obviously that's going to lead to huge tax savings, but come 8 to 10 years down the road, all of a sudden there may be this huge tax bill, right? So the key here is, as he's getting close to that end date where he might start having to pay income tax again, he takes all of this money he's made, and if he hasn't done so already, and acquires more property, where we do another cost segregation study, and then we take these huge depreciation deductions and continue to not pay tax on the profits related to rental activities or income that his wife is earning as a licensed therapist. So the real estate professional status designation, the power in it is that you can, real estate losses, which are, sometimes they are true cash flow losses, but oftentimes they are losses due to depreciation, can be used to offset ordinary income. So let's say you as a realtor are earning, $200,000 from real estate commissions. And you have a partner who's also earning another $200,000 in whatever it is they do for a living. And you're paying taxes on a $400,000 tax bill. But if you have real estate professional status and you've got the type of property where you can take these strategies to take advantage of depreciation, you could significantly lower that taxable income from 400 down to 3, 2, 100, just depending how large those annual quote unquote losses are, and completely offset that income or to whatever the amounts are and have a really low tax bill. So this can be powerful for people who are not real estate professional status. The passive activity losses are limited to $25,000. So someone can still generate a passive loss of $25,000. And let's say they earn $200,000 that year in profit or on a W-2. They lower that income by $25,000, so they don't pay taxes on that $25,000. Another thing that's important to know is for the requirements, there is pretty strict documentation that has to be kept, because in the event of an audit, we will definitely have to prove that you've met the requirements. And the way to do that is by having logs. Essentially is the gold standard, but it isn't the only way. But let's look at what these rules are for real estate professional status. More than 50% of the person's work has to be in the real estate trades or business. And the IRS likes to use income as kind of the baseline here, meaning more than 50% of income. But it would also be possible for it to be more than 50% of people's time. So it really depends on the facts and circumstances. But in general, you have to show that your activity is at least 50% in the real estate trade or business for it to be to meet one of the tests to be a real estate professional. So for example, there are situations where one spouse is maybe a realtor, or they can be anything, and the other spouse doesn't work. If that other spouse that doesn't work is willing to engage in this real estate type of activity, which could be property management, could be scoping out new properties, could be development, it could be a lot of these different activities that happen in real estate, could be flipping, it could be a lot of these activities. If the other spouse spends half of their time in this area, one spouse could be earning $200,000, $300,000, $400,000 a year, while the other one is the one that has a real estate professional status designation. And as whatever activity they're engaging in, if it does lead to these paper losses due to depreciation, the losses from one spouse are able to offset the losses from the other. So whatever party decides to qualify for this real estate professional status, it has to meet this 50% requirement. The second requirement is it has to be a minimum. You have to be able to show that you spent 750 hours in these real estate related trades / business activities. And this is where the IRS gets a little pickier on the log requirement, right? So if somebody owns a few apartment buildings, you have to show what activities you're engaging in and have time estimates of what your schedule looks like. You know, how long does it take you to collect all that rent? How often are you having to evict people? How often do you deal with bringing repair people to the apartment complexes, or do you do the repairs yourself? You know, how often do you need to just deal with tenant issues, permit issues, construction issues, everything related to managing these properties? It could also be property management for others. You don't have to own these properties, but nonetheless, managing the real estate related activities. So all of this needs to be documented, and you need to be able to show an annual commitment or expenditure of a minimum of 750 hours. It has to be material participation, meaning you're the one doing this, right? It can't just be, I called someone to handle it. Now, let me explain what I mean by that. If it's collecting rent, your interaction, let's say you have a property manager and you talk to your property manager for 30 minutes a month, then your time commitment is 30 minutes a month of material participation. But if you're the one doing the active property management and you're the one collecting rents on 30 units or 60 units or whatever the number is, then you're going to have a lot more than 30 minutes of material participation. So material participation is the actual activity in which you're engaging in. If you have a property manager, under certain circumstances, you know, their activity can be attributed to you as well. For sure, if you have employees operating the business, because it's you doing all of this, carrying on this activity. So this gets a little dicey, but in general, material participation means you are doing something. You're not just, you know, owning these properties and then doing nothing the rest of the year. And then meticulous proof. You know, this is not one of the tests, but in an audit, the standard of proof is called preponderance of the evidence, meaning is it more likely than not that this is what's going on. But especially in the area of real estate professional status, we kind of have to go above and beyond to show and prove to the IRS that the person meets the criteria, especially when we have situations like that client I mentioned who isn't going to pay any taxes for probably the next 8 to 10 years. And because of course, Uncle Sam wants their cut, you know, they want their pound of flesh every year, and they're going to look at this and make sure that the person truly qualifies for this real estate professional status. And in order to offset income from other businesses or other jobs. And let me give you an example of this client that I've mentioned, kind of what their situation looks like. Between roughly 13 properties, they have somewhere around 70 to 80 different units. And the husband actively manages all of the units himself. Sometimes he'll even do repairs himself. When he can't do it, he'll hire people to come in and do the work. He'll be on site. He handles all of the day-to-day. I mean, it's pretty much his full-time job. He's definitely spending all his time in it. So he definitely meets the 50% rule. And he does exceed the 750-hour requirement easily. You know, someone working a full-time job works usually right around 2,000 hours a year. So 750 hours would be something like 5 months of full-time work or so. So it's not, for someone whose main activity this is, it's, you know, not the most difficult thing in the world to reach that 750-hour requirement. But so this gentleman, you know, clearly does. And as I'd mentioned before, his wife is a licensed therapist. She makes a great income from her practice. She owns it. And then they have rental income from all of these units. And between the rental income and with the wife's income, they're virtually going to have no tax bill, like I said, for about the next 8 to 10 years because of the cost segregation studies that have been done. And I've used the term cost segregation study a ton of times. So let me explain really quick what it is, just because maybe not everyone's familiar with it. So what happens is, you know, I'm sure you've all seen a property tax bill from the county where, you know, Santa Clara County, somebody buys $1 million property, about 700,000 to 800,000 of that is determined to be land value. and 200 to 300,000 is improvement value. Maybe those are changing now because cost of construction is so crazy high. But you take that, and what happens is you hire someone who's going to create a report, and they're going to do an analysis and determine how much is that land value, how much is the cost of the concrete, the roofing, the framing, the plumbing, the flooring, you know, all of the different components that make up a structure, fencing, you know, gazebos, anything that exists on the property, you know, concrete, driveways, all of that type, parking lots. And then each of those items is going to have a depreciable life attributed to it. And pretty much everything with the 15-year or less life, you're able to take bonus depreciation to where you could essentially take the entire cost of that item and depreciate it in year one. So it makes your income go down from other activities. Anything not used carries over to the next year and the next year and the next year. And of course, you know, you would plan all this out so that you're taking the right amount of depreciation from year to year based on the activity that's anticipated to occur and to anticipated rents, things like that. So that's what a cost segregation study is having a report put together that will break down the cost of improvements on a piece of real estate, and then everything is broken out and given its own depreciable life. Everything's set up as part of the asset, and then everything is depreciated according to whatever is deemed appropriate and to benefit the taxpayer. All right, so we've covered the second topic there, real estate professional status. So we'll move on to some business deductions for realtors. So I think my biggest piece of advice, and this is super basic stuff, but also super important, and I see a lot of people in real estate business not do this, is use a separate account for business. Doesn't even have to be a business account, but just have a separate account where you deposit your commission checks, and then from that account you spend money for everything that is business related. And then when you are going to pay yourself, you just transfer money from that business account over to your personal account, and it takes 2 seconds. You know, you could do that once a week, once a month. You could really do it whenever you want, but the fewer transactions, the simpler it is, and the easier it goes. Second thing is, when it comes to these accounts, do not mix personal and business. Again, if you do, not the end of the world. It's just going to be a lot more work to now break out what was business versus personal. Somebody has to do that. Either you do it or you pay your tax person to do it. And then the other piece of advice that's super important, which again, I see tons of people in real estate make this mistake, is track expenses as you go. You know, now it's December. Hopefully you've all been tracking these expenses as you've gone through the year, because come January, February, there's no way you're going to remember what you did last March, April, May, June, July. And even if you are using a separate account for business, it's quite likely that you're not going to remember what every single transaction on that statement was, you know, 6, 7, 8 months back. And hopefully you have all the receipts, which will make it easier to figure that out. But if you don't, then you're really, you know, you don't want to leave money on the table, I think, is the biggest thing. And to give you an example of what I mean by that, you know, you could easily be in the 24% tax bracket for federal taxes and in the 9% tax bracket for California. So between those two, you're at 33%. And then don't forget that roughly 15% Social Security and Medicare tax. So we're looking at tax rate, and it's not quite this cut and dry, but we're looking at taxes of over 40% now. So let's say you bought a chair for $1,000 because it's ergonomic or something, and for whatever reason, you didn't track it, you didn't buy it out of a business account, you didn't save the receipt, and come tax time, you just forgot to include it as a business expense. Now what just happened is you paid $1,000 for that chair, so that's a big downside, which you would have done because you needed it, so it is what it is. But the real big downer here is you're not going to include it as a business deduction, which means you're going to pay taxes on $1,000 that you should not have paid taxes on. And if the rate is over 40% between federal, state, Social Security, and Medicare, then that means you're also going to pay roughly $400 to $500 in taxes that you should not have otherwise paid if you had tracked that expense. So that chair no longer costs you $1,000. Now it costs you like $1,400 to $1,500 when you add in the taxes that you should not have paid had you tracked it. So forgetting things that you've spent money on as it relates to your business is very, very expensive, and it can cost you a lot of money. And that's why I say track things as you go. You know, if you're using a separate business account, you could set up a real basic QuickBooks account that's purely expense tracking and do that. You could export the expenses every month and then go through and give them a category, make a note on what they were. You know, there's a bunch of different things you could do that you just do not want to wait to tackle a year down the road. All right, so we'll jump into and another comment on business deductions. Ask yourself this every time you're spending money, and if it's in any way related to work, it's probably business deductible in some way. Even if it isn't 100% deductible, it's probably business deductible, a percentage of it. So if you would not be engaging in this thing or spending this money, but for the fact that you are a realtor or in business for yourself, then it's going to be business deductible in some way, unless it's some kind of like parking ticket. You know, generally parking tickets, speeding tickets, violations of the law aren't tax deductible usually, but there are some exceptions to all that stuff, so I won't get into it other than that. But the point is, if you track everything, you'll at least be able to ask these questions come tax time or whenever you're talking to your tax pro, so that you don't leave money on the table. So vehicle deductions, there are, regardless of the option you choose, you want to keep a mileage log. And because if you choose the mileage deduction, then you need that log to know how many miles you drove. If you choose the actual expense, I put action expense, I apologize, I need to fix that. But if you chose the actual expense deduction, then you need to know how much of that vehicle's use was personal versus business. You know, if you drove 10,000 miles for the year and 9,000 were business miles, then 90% of all those expenses are business related. And without a log, you won't really know that. Now, that is the gold standard, right? Another thing you could do is, you know, get an oil change in January, get an oil change the following January. You'll always know how much you drove during that year. But what you won't know is how much was personal driving versus business driving. So that's where the log comes in. And, you know, if you don't have a log for the year, don't be afraid to take the deduction and, you know, just use your reasonable number, but also know that in the event of an audit, there may be some changes to whatever number you use, depending how aggressive you were. But even in an audit, you know, you can defend things. I literally just closed an audit a couple of weeks ago from an individual who was self-employed. They were not a realtor, but they were kind of a door-to-door type sales job. And I know you realtors drive around with buyers a ton, especially in this market where there are 30 offers to a house. It's probably pretty difficult to get an offer accepted. So you probably have to show your clients more houses than you would in a buyer's market. And anyway, and for this audit, this individual had to drive quite a bit, and he did not have a mileage log. And we got pretty creative in the way I defended it. Is I ended up asking him, well, you know, what do you have that would show mileage driven? I just started asking him questions. I said, how about, you know, your auto insurance? Some companies ask you how much you drive every year. Do you have to report that annually? He says, you know what? I haven't in a few years, but I used to. So he went back, sent an email to his agent. They sent him a breakdown of what he'd reported back in 2015, 16, and 17. And what I did is I took this mileage that he would report on his odometer each of these years, broke out what that mileage would have been per work day, assuming a 5-day work day, multiplied it out, and then I just looked up data on people, businesses where people drive quite a bit, took some percentages, multiplied it, and I put together this sheet where I just went step by step breaking things down. And the auditor, they accepted my numbers, they didn't change them. And he had a good win there because he literally had no records to prove any of this stuff. So, be reasonable. Don't be afraid to take the deduction if you don't have a log today, but going forward, keep that log. Another piece of advice on vehicle deductions is start your workday at home. Have a home, if you have a home office, start it at home, shoot emails, do your cold calling, whatever it is you can do from your home office. Because if you start your workday at home, the moment you leave your home, that's deductible mileage. If you wake up and you drive to the office outside of your home, that drive to the office was not a deduction because your workday hadn't begun. But if you woke up, you got ready at home, you started your workday at home, the moment you drive away from your home, whether it be directly to a client, to show properties, to the office outside the home, that mileage is deductible. So the two options are mileage deduction, which for 2021 is 56 cents a mile. This is the most basic way. If you drove 10,000 miles, you multiply that times 56% or 56 cents, and your deduction for the year would be $5,600. The deduction, this mileage rate, is intended to capture the cost of ownership of the vehicle, maintenance, gas, insurance, repairs, things like that, depreciation, all of that stuff. Catch-all number. Obviously, if somebody has an electric vehicle or hybrid or something, you spend a lot less on fuel, but there's just still one mileage rate regardless of the type of car it is. If you decide to go with actual deduction or actual expenses, not action, but actual, that means is you're going to deduct depreciation. That's essentially the cost. So you don't get to deduct your monthly payment. What you deduct is the value of the vehicle. You break that out. Vehicles have what's called a 5-year life. You're able to take an initial bonus depreciation. So in year one, depreciation is larger than other years. And then the other 4 years, that depreciation number continues to decline until you've fully depreciated the vehicle. And then you're able to take a deduction for the rest of your expenses, your fuel, your insurance, maintenance, repairs. So these expenses, it'll be a ratio of what I was mentioning earlier. If your vehicle is used 90% for business, then 90% of the vehicle's cost / depreciation is a deduction, 90% of all operating expenses. If it's only used 10% for business, then 10% of the depreciation, 10% of all operating expenses are deductible. So that's another reason why auditors are very picky about these mileage logs. And then, as I mentioned, the percentage of business versus personal, and that's why that log is needed. A little bit more info on the vehicle deduction, specifically the depreciation. If a vehicle is under 6,000 pounds, it is right around $11,000 first year depreciation, or 50% of purchase price if it's a new vehicle used exclusively for business. If it's a vehicle that's over 6,000 pounds, which is usually like a large SUV, the first year depreciation can be $25,000 or 50% of the purchase price if it was a new vehicle and it is exclusively used for business. There's a ton of rules on depreciation, so I'm just going over like the basic things that are kind of like good to know off the top of your head things. And then the other thing that's important to know is that you're going to add depreciation to your income in the year you sell the vehicle if you sold it for more than what remains of the book value. Let me explain what that means. Say you bought a $50,000 car. After 5 years, it's fully depreciated, meaning your book value is now zero. So not Kelly Blue Book, but meaning book value as in your accounting book value. It's now zero because you've taken business depreciation on the entire $50,000. And 5 years down the road, let's say you sell it for $15,000. In that year, you're going to have to include $15,000 in what's called unrecaptured depreciation as income on your tax return for that year. Now, if that year you go out and buy another vehicle, you'll probably be able to offset that. You're just probably not going to have as large of a vehicle benefit for that year because you had a $50,000 car, which you completely deducted. So you didn't pay taxes on $50,000, but then you sold it for $15,000. Uncle Sam takes the position that now you should be paying tax on that $15,000. So sometimes difficult to understand concept, but just know that this will come into play when you sell a vehicle where it's been depreciated. Home office. So home office can be a great deduction. It's should be exclusive use, whatever area you're using for a home office. If you have an entire room, that's great. If you have a corner, that works too, as long as it's exclusive use. Percentage of the whole. So let's say you have a 2,000 square foot house, and to keep the math simple, let's say 500 square feet are your home office. That's 25% of the whole. You'll be able to deduct 25% of your mortgage interest or rent. Of course, property taxes, if you're paying property taxes, 25% of your insurance, 25% of utilities, 25% of some repairs and maintenance. And of course, every single dollar of things actually spent on the home office, meaning like if you buy a monitor, if you bought a chair, if you bought a printer, all of those things fully deductible. But this refers more to like the expense of paying for the office, much like if you went to rent an office outside of the home. So it'll be a percentage of the whole based on square footage. And this is something that pretty easy to calculate because square footage is not the most difficult thing in the world. The key here would just be not forgetting to add up your insurance, utilities, property taxes, rent or renter's insurance, all those things, whether you rent or own, there's a separate list of items, and then taking that deduction on your tax return. We won't get into all of the nuances between S-Corp and sole proprietor, but this is certainly also possible if you're an S-Corp. But the way it would happen is you come up with these calculations, you have to reimburse yourself like when you submit an expense report. So you submit an expense report to your own S-Corp, you pay yourself back. So what that means is the S-Corp will take a deduction for that home office based on your expense report figure, whatever that number is. And then when you receive that money, that is not income because it's a reimbursement to you for a business expense you had out of pocket. So this works under either method, whether you're sole proprietor or S-Corp. So don't forget to set up that home office and take advantage of this benefit. Another thing I mentioned earlier, start your workday at home. The home office deduction rules are separate from proving you started your workday at home. So even if you don't qualify for this home office deduction because you don't have an area you're exclusively using for business, if you can show that you started your workday at home, you are able to take that deduction the moment you drive out of your home. So just wanted to point that nuance out. Expenses to close the deal. These are super, I've seen auditors try to disallow them, and usually we're able to win to keep them on the table. I would say 9 out of 10 times, but you definitely want to help yourself and protect yourself. Document them a certain way so that they don't try to claim that these are gifts, because gifts are limited to $25 per client, which is nothing, obviously, especially if what you're gifting them is a refrigerator or a dryer or a washer or something pretty expensive. So these things are not gifts oftentimes. It's part of something that you have to do to close a deal. Maybe there was an issue in escrow, or maybe there was a problem with an inspection. So there's all sorts of things that happen in these transactions, and they usually happen toward the tail end of the transaction. And you realtors really have to go above and beyond to save the deal. And that above and beyond, oftentimes money means money in some way. So the best practice is to give the client some sort of credit via escrow. And if you do that, it'll show up as a lower commission on your end, and the payment went directly to the client, which means there's less income to you. So overall, you achieve the same thing. It's a deduction in the sense that your overall taxable income is lower. That ends up being that you are giving them, again, a refrigerator for something that occurred at the end of the deal. Make sure they're sending you an email explaining why it is you owe them this, and then you're responding, saying, yes, I agree because X reasons. And it's part of making the transaction, being able to close that deal, and just save that. Think of that as a receipt. Obviously, you'll need the receipt for the refrigerator, but save that with the receipt for the refrigerator, because that way you're able to show that you didn't buy that fridge for your own home, or that you bought it for your mom, or you bought it for some random person. And you're able to show that this was related to a very specific transaction, and that it was a business expense that was necessary to close this deal. Donations or advertising. Here's another area where a little advice can go a long way. Realtors oftentimes, already are paying for things where their picture or their name or their logo or their team's, their group name is being included on a banner or some sort of pamphlet. But because they donated, they paid the money, let's say to a church, they think it's a donation, or they list it as a donation. And words matter. The IRS see donation in a set of books or in a set of records, and they're automatically going to just disallow it. So you want to, quote unquote, pay for advertising and get your logo displayed. If it's a toy drive, make sure that your logo is somewhere in that program or in that event. People often donate to their church. Put your logo in the program, in the banners, and make it a payment for that particular thing. The objective is still being achieved. You're still helping the tax exempt entity that you want to help, but you're also getting a business benefit from it. That because there's a business benefit, you're now allowed to take a business deduction. Little League banners and other nonprofits. The examples here can be endless, but the key is treat it as if this were advertising. Try your best to have your information displayed in some manner. Save the way that occurred. If there's some sort of email or agreement that shows what that was, save that. Some places will actually give you an invoice for a contract, and save those, whatever they were, so that you're able to take that deduction. Then expenses in general, save your receipts. The bank statements may not be enough. Let me give you an example. Let's say you have a bank statement and it says SCorp, Santa Clara County Association of Realtors, and it's $450. That's in an audit, that's not going to be an issue, because it's pretty clear that pretty much everything SCorp does is related to the real estate industry. They might sell, I don't even know if they sell snacks in their store, but that would be negligible compared to the fact that you're probably really paying them for your dues or your Supra Key or MLS dues or other types of things that end up being paid. But let's say you did have one of these situations where you bought a refrigerator for a client, you didn't save the receipt, and it says Costco on your bank statement because you purchased it at Costco. Well, Costco sells everything under the sun. So in an audit, we need to convince an auditor that it was a business related expense. And that's why bank statements may not be enough. So if you purchase something at Staples, probably no issue. If it says Costco, we're going to prove what that purchase was. We're going to need to prove what it was and how it was related to business. And that's where the receipts come in. If you don't have a receipt, there's no law that says you need a receipt. It's just the best practice and kind of the easiest thing to do. But if, whatever reason you bought that refrigerator used, take a picture, timestamp it, save it, and attach it to whatever transaction or client file it relates to. And that also will suffice, because it's a proof of purchase. It's a proof that something happened. It's a proof of an expenditure. And at the end of the day, that's what we need to prove in an audit, is that you took a business expense. And then no business, if you have an expense that was related to a business and it's going to likely be deductible. I talked about this a few slides back. But in general, if you're spending money related to business, it's deductible. The other thing super important that I forgot to put on the slide, and I'll say it before I forget since it's not listed here, in 2021, hot meals from restaurants, whether you eat them in a restaurant or you do takeout, if they're business related, are no longer only 50% deductible. They're 100% deductible. There are special rules for what needs to be documented there. A receipt is required and needs to detail what was consumed. And usually the separate little slip that has the tip line and the total, you'll want to save that one as well, because not only do you want to know the total for the meal, you also want to know what that total was including tip, because that's the amount you want to deduct. And then the last item that's required, and it doesn't have to be a whole paragraph or some big story, but what is the business purpose of this meal? So let's say we were to go out to lunch. We go to a restaurant, it's $50 each, $100 total, including tip. Had lunch with Juan, discuss tax planning strategies. Good enough right there. It's clear that I'm an enrolled agent, clear I'm your tax person, clear we had that conversation we had over that meal, and that's good enough to list. So there are very few things that have very specific documentation requirements, but business meals is one of them. And in 2021, it's 100% deduction. So don't forget to go back and gather that data for 2021. And that 50, I'm almost 100% sure that in 2022, it's also a 100% deduction. But on that one, don't quote me. Ask your tax bro if you want to confirm that piece. But nonetheless, just remember business meals are deductible, hot meals from restaurants. Mixed use items, don't forget that something like a cell phone, subscriptions, and every industry has different things on what those may be. But at the end of the day, if there's something that you're using and you're using for business, even if it isn't 100% deductible, a percentage of it may be deductible. So on a separate spreadsheet or a separate tab of a spreadsheet, make a list of spend some time thinking about what all these things may be, make a separate list of what all these things are, and have this discussion with your tax advisor so that you can say, okay, yes, deductible, not deductible, how much, what percentage of it is deductible, and you make those decisions, because again, you don't want to leave any money on the table. You're probably close to a 40% tax rate between federal, state, Social Security, and Medicare taxes, and you don't want to pay more taxes than you need to. Here's a few tax saving strategies. Max fund your retirement accounts. If it's a SEP IRA and your profit is over $260,000, you could literally put somewhere in the neighborhood of $58,000 into retirement accounts, which means you wouldn't pay federal or state tax on 58 grand. You would still pay Social Security and Medicare, but not federal and state taxes. And again, if you're in that over 40% tax bracket, then you're going to end up with a savings of nearly, $20-something thousand, approaching $30,000 even. So can be a huge tax savings. You're making Uncle Sam help fund your retirement. Invest in your business if it makes sense. And the reason I capitalized if it makes sense is oftentimes, especially this time of year, I hear all this nonsense of, let me go buy a new whatever so that I pay less in taxes. Well, let's just say that whatever costs you $1,000 and you're saving $400 in taxes. And if you didn't really need that thing, you really cost yourself $600 because you're saving $400 in taxes, but you paid $1,000. So only invest in your business if it makes sense, because it's great to save on tax, but it's not great if you're actually costing yourself money. And then another thing is know what credits and benefits apply to you and your family. This isn't just related to realtors or self-employed people, but many of you might have a spouse who is an employee or with a W-2, and a lot of companies offer HSAs or FSAs or tuition assistance where, they might pay for college up to $5,200 per year, which is not taxable income to the person receiving the benefit, but the company has that benefit. Or if any of you have employees and you pay up to $5,200 in their tuition, you get a business deduction, which means you don't pay tax on $5,200. The employee doesn't pay tax on that $5,200. And if their salary was supposed to be $55,000, instead you pay them $50,000 and $5,000 as a tuition payment, then it's a win-win all around. No one pays tax on $5,000. And for you as a business owner, I guess you don't care whether you pay $5,000 or $55,000 or $50,000 plus 5 because your deduction is the same. But nonetheless, something to know here, and something that if it applies to any of your spouses, you're taking advantage of child care assistance. A lot of companies offer, again, about $5,000 where it's pre-tax money you put away. So if you're not paying federal and state tax on $5,000, again, it's probably a nearly $2,000 savings pretty easily just by taking advantage of these benefits, the dependent care credit, and then there a handful of other credits. So know what applies to you and your family. Have these conversations with your tax advisor, and that will help you save money. And here, the last thing I'll talk about really quick is hire your child. If they're 17 or under, make it legitimate. You guys do a lot of work. You guys send out mailers, social media management, email lists, like all kinds of farming related activities. There is so much that your children, depending on their age, can help with. I have a client who actually pays a social media content company about $4,000 per month to manage social media accounts. This is not a child doing it, but my point in this example is that this client is paying nearly $50,000 a year for social media management. They probably do a better job than your child. But if your child is doing work for you, document it, create a job description, document what they're doing. And the first roughly $12,500, because that's a standard deduction from a federal perspective, they're not going to pay any income tax on that. And if your tax rate, again, let's say it's roughly 40% between federal, state, Social Security, and Medicare, you're not paying tax, which is over $4,000 in tax savings just by deploying this strategy. And if you have multiple children that can all be helping with something, then you could easily be saving $4,000, $8,000, $12,000 a year. Again, it all depends on your facts and circumstances. It all depends on how much, how busy you are, all of that kind of thing. But the key here is make it legitimate, document the activity, have a job description, and treat it like you would with another employee. Document kind of like on a timesheet, whether a spreadsheet or something, so that you're able to show what they did and when they did it. And even if that payment exceeds $12,500, let's say it was $20,000 for the year, well, they'll pay tax on $7,500 at the lowest tax rate, which is going to be a tax rate that's a lot lower than yours. And the other thing is, if your child's 17 or under, they will not pay Social Security and Medicare on this money, which means it's savings all the way around on that amount above and beyond $12,500. If they didn't do that $20,000 worth of work for you, you would be paying Social Security and Medicare tax on that. But deploying these strategies where it makes sense can save you guys money. So down to the wire here, 11:59. I hope you guys found this information useful. Here's my information if anybody wants to screenshot it. And I thank everyone who attended, and I hope you learned something new today. If anybody has any questions, best way to get a hold of me is shoot me an email, but even more important, if you want to have a chat, is set up an appointment via Calendly, and it's there. It's calendly.com/the tax problem. Phone number is also there, but usually everything's done by appointment. So hope you all have a wonderful rest of your holiday season. You really enjoy all this beautiful time with family and friends, and don't forget to do your tax planning before year end, because come January, there's nothing you can do about 2021. Hope everyone has a great day.
Thanks, Juan.
Thank you.
My pleasure. Thank you.
Thank you so much. It's very helpful.
Awesome. Well, you guys have a wonderful day. Unless there's someone who has a few quick questions, I could stick around, but if no one has
I
questions,
have one question.
yeah, absolutely.
You mentioned an SEP, a SEP IRA. What's that?
The SEP stands for self-employed pension.
Okay.
That's think of it kind of like an IRA, except it's specifically for self-employed people. So,
Okay.
so let's say you bank with Wells Fargo or Chase, you're able to set up IRAs through them, and the same would apply with that particular thing. Meaning, as long as you do it before your tax return is filed on April 15th, you're able to contribute into your retirement account. And you will, any amount that you contribute, you will not pay federal or state tax on. You still will be subject to Social Security and Medicare,
Okay.
not federal or state taxes. And then what that means is, again, if you are in the 24% tax bracket for federal, roughly 9 for California, and you're able to put in $15,000, right? You're going to save somewhere around $6,500 in taxes by doing that. Meaning you're putting away 15 grand for your future self, but it truly only cost you about $8,500.
Wow.
So that's
Okay.
powerful. And the other thing that I tell people there is, I'm not a financial advisor, and what I mean is I don't tell people how to invest their money or where to invest their money. If people aren't already doing something, I think something is better than nothing. But if you have a financial advisor, obviously make sure whatever strategies you're deploying kind of line up with your financial plan and objective. And what I mean by that is I had a call week before last. It was a three-way conference call with my client and self-employed person and their financial advisor. And in their case, they've got plenty of profit, but they've decided they'd rather pay the tax bill because they want to invest in after-tax investments rather than save tax now, because down the road when they tap into those retirement accounts, they're going to have to pay a tax bill. So they've done the math on their end where they believe that's a better strategy for them. And again, nothing wrong with that. Just, but if you don't have a financial plan, like I was saying, something's probably better than nothing.
Right. Thank you.
My pleasure. Any other questions?
Yeah, Juan, would you get your contact information up there one more time, please?
Yeah, absolutely. Let me see here. Can you see that?
I sure can. Thank you very much.
My pleasure. Actually,
Okay. Hi, this is Maha. I had a question also regarding the donation to church. Even when you get a receipt from the church, it's not deductible?
right. So if it's purely a donation, then there is no business benefit, because for a deduction to be a legally permissible tax deduction, the term ordinary and necessary is kind of this, I know those words don't really mean an awful lot, but in the tax context, ordinary and necessary is a test that the IRS always uses to determine whether something is business related. So if you gave away X number of dollars out of the goodness of your heart, there's no benefit there from a business perspective. But if the church, actually with pandemic, there's a lot of paper that's gone away, but a lot of churches, I'll say pre-pandemic, I've seen they had a Sunday, a flyer or some kind of program or an agenda, and they would put local businesses logos on there who support them. And if you're doing that, then you're really paying for marketing, because your information is being put out there for anyone who puts their hands on that document. So yeah, I mean, short answer, if it was a donation to Habitat for Humanity and there was no way your information is being put out there, then in an audit, the auditor would look to disallow it. Obviously in an audit, I'm going to fight tooth and nail for my clients, and argue how your name got out there and everything else. But the more I have to prove it's business related, the better we're going to do, and the more of these deductions we get to keep. So best practice is try to get your logo / contact info / business card in the pamphlet somewhere if you're donating money, because oftentimes most of these entities do have some way to promote you. Maybe it's a little badge on their website or whatever it is, social media. I don't know. There's usually a way to do it. So, but to answer your question, if it's just a standalone straight up donation, auditor will always look to disallow, and then we're going to, on our end, have to prove how that was business related.
It would be like I'm giving them the choice to use it for toy drive, for food drive. They help, homeless. When we do a toy drive, we don't have our name or anything, but we can deduct it.
Well,
Wow.
so I guess let me be clear. Right now, I'm talking about business deductions. But if you have a Schedule A where you write off your mortgage interest, property taxes, there you can absolutely take the deduction. But on the federal and state tax, it still helps you because you're not paying federal and state taxes on that donation. So I'm glad you bring that up. I should have been more clear. But the benefit to having this be a business deduction instead of a personal deduction on Schedule A is that you also don't pay the 15.3% in Social Security and Medicare tax. So I have clients who donate over, easily $10,000 a year, and just Social Security and Medicare tax alone, it would be a $1,500 difference. They won't pay federal or state tax, no matter whether it's Schedule A or sole proprietor Schedule C. But the fact that it's set up as advertising, they also save an additional $1,500.
Gotcha. So what you're saying, I can do it on my personal, but not on the S corporation? Is that what you're saying?
No, I actually wasn't talking about SCorps, but for SCorps, you definitely have to show that there's a business component to it, or else, again, it's not a business
Right.
deduction.
Oh boy. Okay. There's thousands goes there every year.
Yeah. Again, if somehow they're putting your name out there, right? Let's say there's nothing.
They don't have pamphlets, nothing since the COVID anyway. Nothing. It's all gone.
But it could be something like social media or at the beginning of the event, we'd like to thank our sponsor, Maha Incorporated. So if what they're doing is verbal, you want to have some sort of contract with them where they're saying that they're promoting you at the events, for example.
Oh boy.
When I say contract, that sounds real fancy, but it could simply be a one-page document where they're explaining what benefit your corporation is receiving. And again, if there's no audit, then they're not going to.
And I'm okay.
And I don't want to say you're okay, because you also want to be able to feel comfortable that this is a business benefit, right?
Yes.
If you're writing it off on the business side. So just keep that in mind. There has to be a business angle to it.
Okay. And another thing about material participation, the time that you spend on your rentals, where would you deduct that? Is that like you deduct it on your real estate income / expenses?
Good question. So the actual expense that you're incurring will either go on Schedule C, or it will go on your SCorp, or it will go on Schedule E if it's a passive rental property. So the actual expense will show up wherever that activity is being reported. But the material participation test I was referring to is what the IRS will look at to determine whether they will allow you to be a real estate professional status, so that your losses from real estate activities could be larger than $25,000 per year.
So I would put the time that I spent myself to manage.
Yes, think of it as a log. You would have, a calendar essentially, where you're saying today these were the activities I engaged in, and I spent 4 hours on it, or 2 hours, or whatever that time frame was. And then you would want to save that log. Maybe the easiest thing is a spreadsheet on your computer somewhere. But yeah, that's what I was referring to. They'll look to see that you've spent 750 hours. Now, obviously, there's a big difference from somebody who owns one rental property. The auditor will be a lot pickier to show that you've spent 750 hours, because on one rental property, that might be kind of a stretch. But if you know, like the client, one of the client that I mentioned numerous times that's got 70 to 80 units, it's pretty easy to spend 750 hours when you've got 70 to 80 units.
Unless you updated one unit, you upgraded everything, and that just absorbed all the project management hours that you had to take care of one of the units, right?
Right. And that's why everything's facts and circumstances, right? And so, yeah, absolutely. If you're day to day at the job site managing a flip, that's certainly going to be a lot of time, but you'll want to document that, because remember, an audit's going to happen probably a minimum of 1 year in the future, probably 2 years in the future. And you need to show what you did 2 years ago. And just a verbal, this is what I did, is not going to be good enough.
And okay, so once you put the hours, do you put a dollar sign for the cost of the hour or what?
No, because this is not a deduction. This is just to prove you spent that amount of time.
I'll get you.
So yeah,
Okay, so we get the status.
yeah,
Okay,
think of this more like a time log if you were an employee, just showing what you did on what day and how long it took you.
okay.
Good
All right.
question.
Thank you so much.
And I can
This
actually
is-
do one more.
This
One
is Myrna. I have a quick question. So regarding the donations, as Maha has mentioned, what if we work with nonprofits, organizations, and they host us to do events? So, but they're not charging us. So we want to make sure that, at least for me, I want to donate. So how will be the best way to do that? Like to thank them for hosting us, because we're not really paying for it. But I do want to make sure that I donate back to that nonprofit that is supporting us and helping us.
that's a good question. So what I would ask is, I'm sure there's some kind of communication via email.
Mm-hmm.
And essentially think of it as, tell them, you're going to, I don't know what the numbers are, but let's say $500, right? Let's say
Yeah.
$500. And you're going to appear at an event that's going to benefit you because of that exposure.
Yes.
And you're paying them $500 for them allowing you to present.
Got it.
Because, for
So-
example, let me give you an example. In my industry, I teach, actually, when I introduced myself, I didn't mention this. I write tax classes and I teach tax pros across the country on a whole bunch of different tax topics, crypto tax, real estate tax, all kinds of different things. And I get paid from all of these places that hire me to teach. But there's this company that's been reaching out to me for a few years now that I always tell them they're crazy and they need to leave me alone. But they want me to appear on their platform, but they want me to pay them $5 for every attendee, because they say I'm going to get all this great exposure that's going to make me in the future more money, right? So,
Mhm.
so that's kind of, look at it that way. If you're going to present at a nonprofit, no ad that's going to be anywhere, but you are the ad. You're the walking, talking ad at that event.
Mhm.
And in the email say, hey, for allowing me to appear on X date for X amount of time and present, I'm going
Mm.
to give you $500, or your fee is $500, blah, blah, blah. And that's right there is literally marketing / advertising.
Got it. Okay. So basically, yeah, they're helping me advertise myself and help the community at the same time.
Absolutely.
Okay. So as long as there's an email saying, stating that, then I can write a check and that will be an expense.
Yes,
Got it. Thank you so much.
my pleasure. Any other question? One more question, and then we'll all go have lunch. Yep. All right. Thank you guys very much. Great questions, and I hope it helps. You guys have a wonderful holiday season, what's left of it.
Thank you.
Bye-bye.
Bye-bye.